Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra. Would like to increase your financial IQ with today's discussion. I'm a little late getting to this topic, but it deserves some attention. By the time this is published, this episode will be, a bit into 2024. I want to take you back, though, to 2023 and talk a little bit about economic growth in 2023. Using real GDP, gross domestic product. Good news is GDP growth was 2.5% in 2023. It's a pretty good number, better than expected by most people, I think. It compares favorably to 2022, where real GDP growth was 1.9%. So we saw an improvement year over year. More good news is that the year finished more strongly than it started. The annualized GDP growth in the third quarter was 4.9% and a solid 3.3% annualized growth in the fourth quarter. So the second half of 2023 showed greater economic growth than the first half. So we feel as though things are accelerating, that economic growth, the strength of the economy is improving. As of mid-February 2024, let me say that there's this GDP growth now that's put out by the Atlanta Fed, and it has annualized projected GDP growth, real GDP growth for 2024 of 2.9%. So this strengthening I just talked about, this acceleration, is sort of at this point built into the GDP now estimates. Of course, that can change, but hopeful signs, I think you would agree. This, by the way, helps explain the stock market rebound in 2023. We had a rough 2022, as my listeners, I'm sure, know full well, but we had a healthy rebound. A lot of that was due to inflation coming down faster than most people were expecting. But another element of this was the avoidance of a recession and this increasing or accelerating economic growth story that I'm laying out for you. Again, the recession talk that was really prevalent in 21, 22, and even for a large part of 2023 never materialized. So let's just touch a little bit on this because we live in unique times. And as I've been telling people, this presidential election later this year is going to be a zoo. There's a lot of craziness and probably more craziness to come. But let's just talk a little bit about this GDP growth for a moment. If you listen to the Biden administration, they will assert that the economy is great, that they've done a fabulous job, and that their economic results are the best that you've ever seen or the best you've seen in a long time. There's a lot of hyperbole coming out of the administration. Most, if not all, administrations do this, so I'm not pointing too stern a finger at them. But the reality is that their hyperbole is not exactly true. They are asserting something that has some merit, but they, of course, overdo it. I don't think this is the best economy is exactly true, but it is a good economy. It is a good economy. Does it have flaws? Yes. Are there problems? Of course. Is inflation one of those central ones? Absolutely. But it is a good economy. Now, if you listen to the opposition, they will have you believe that things are horrible, the worst they've ever been. The sky is falling, that the Biden administration's economic record is one of the worst on record. I don't believe that that is exactly true either. I believe the truth sort of lies in between the two polarized stories you get from the Biden administration as well as the opposition, which is largely led by former President Trump. It is a good economy again. We did here at Real Wealth Management a couple of economic updates earlier this year. And so we posted this and used it as a recent Simply Financial podcast episode. But as we move into 2024, let me remind you of a couple of things. Number one, there are some causes for optimism. I already talked about the GDP now indicating a 2.9 real GDP growth estimate for 2024. That would be a very good result for 2024. I think more causes for optimism is that we have a manageable inflation problem. Because inflation has come down so much, it is a much more manageable issue at this point. And related to that is we now have a Fed that's pretty passive. They are seemingly, unless something strange happens, done with the rate cut cycle that they started to combat inflation. That phase is done, and we have a much more passive Federal Reserve right now. And their bias, this is their public proclamations, is that they are likely to cut interest rates as their next move. The big question is when and how much. We'll get to that in a moment. But the bias is to rate cuts, and rate cuts are a cause for optimism for the economy. And then, in my opinion, by extension, the general state of the stock market would be helped by that. As I referred to earlier, there's virtually no recession fears any longer. They have all melted away. We have low unemployment. We have a healthy economy. In part, or a byproduct, is this healthy unemployment situation we find ourselves in. There was a lot of talk when inflation was running hot that the Federal Reserve would have to raise interest rates and make a mess of the unemployment market, meaning drive the unemployment rates higher. That didn't materialize either. The recession didn't materialize. A significantly weaker unemployment market did not materialize either. And the last point, again, I did an episode on this for the Simply Financial podcast, is that we have a healthy consumer, and consumer spending is the largest component of economic activity in this country. So there are some significant causes for optimism. I alluded to this already. There, of course, are problems and things that could derail this economic growth story. And some of the reasons to worry include excessive optimism about rate cut expectations. I think some people are expecting too many rate cuts and for them to happen too soon. For example, in late 2023, the market had a wonderful November and December. I'm talking generally the U.S. stock market. And part of that was expectation that the Fed would be very aggressive in cutting rates, that they might even start as early as March of 2024. That seems extremely unlikely as of this recording. So I think some people might be disappointed at the pace and size of the Federal Reserve's rate cuts in 2024. I am on record saying I think that they will cut rates, but I think that they will go slower than a lot of people are expecting. They will take their time. So that is my position. I will add, for a worry, is that the country, despite this good economic news, is still pretty much in a sour mood. You see it in a lot of the polling. I think part of this is inflation, even though the mainline inflation numbers have come down. I described it as a manageable problem. It still, though, is making its way into a lot of everyday costs. And it's still very bothersome for people generally. And for a big swath of the American public, it's a significant budget issue. So even though it's a manageable inflation problem, it has a lot of Americans annoyed, to say the least. So the sour mood of the country is a reason to worry. If people change their spending habits because of a dour outlook, that could be problematic. We also have tremendous geopolitical tumult. If you watch any news, you know this. We have shooting in Europe. We have shooting in the Middle East. We have tensions with China. There is a lot of geopolitical risk. If something should flare up and worsen, or something unexpected can happen, almost all bets on economic growth would have to change and be reevaluated at that point. Another reason to worry is this election craziness. It'll have people on edge. It's not healthy for our country. as a citizen, I'm upset about what we might see with just tremendous hatred coming from both sides. Hopefully this doesn't happen, but you'd have to put that in the worry category as well. And the last thing I'll say is that we have a fairly narrow market. When you look at the market performance, the stock market has mounted a good rebound. It started in the fourth quarter of 2022, coming off of the bear market of 2022. It continued throughout much of 2023, with 2023's market performance being very good by almost any measure. And we've gotten off to a good start in 2024. So things have been generally pretty good, but it's a narrow market. There's only a handful of companies, nicknamed the Magnificent Seven, that have done most of the performance that's built into the index averages, like the S&P 500 as a prime illustration. So it isn't really a broad rally. There's lots and lots of companies that have not kept up with these Magnificent Seven. So it's a little worrisome because that probably is not sustainable. What would be sustainable is if we see a broadening out and more companies, more industries participating in what I hope is a continued rally. So those are some of the reasons to worry. I'm going to leave it there. Hopefully you found this information to be worthwhile and beneficial. I really appreciate you listening to today's episode of the Simply Financial Podcast. I will be back with you very soon for the next episode. In the meanwhile, go to elliottwealth.com. Check out the work we do here to help our clients win with money and move towards the achievement of their financial goals, and subscribe to the podcast if you haven't done so already. Thanks again. I'll be back with you soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.